G'day, and welcome to this explainer. Today we're going to calmly break down the mechanics of self-managed super funds, and specifically the borrowing structures within them right here in Australia. Superannuation rules can definitely feel a bit complex, maybe even a little confusing sometimes, but we're going to make perfect sense of it all. We'll look at the fundamental rules, how these specific borrowing structures operate, and what the latest regulatory discussions actually mean for the system.
Okay, let's dive right in. Here is our roadmap for today. We'll cover the Aussie super system, what an SMSF is, introduce LRBA structures, explore why LRBAs exist, and finally, look at the current regulatory policy discussions.
Section 1. The Aussie super system and its 3 pillars. To really get into the details, we first need to look at the macro picture of Australia's retirement framework.
So, the Aussie system rests on a 3-pillar approach. First, we have the government-funded, means-tested age pension. Then, there's the compulsory savings pillar, which is your employer superannuation guarantee contributions. And finally, your voluntary savings. Now, what's absolutely crucial to remember throughout this explainer is that superannuation has one sole, strictly regulated purpose, and that is to provide for your long-term financial security in retirement. It's not a piggy bank for general wealth creation or everyday use.
Moving on to Section 2. What is an SMSF? Taking the reins. This brings us to the specific vehicles you can actually use for those compulsory and voluntary savings. You hear the acronym thrown around all the time in Aussie finance, right? But what exactly is a self-managed superannuation fund? Simply put, an SMSF is a private super fund structure. But the defining feature here, the really big difference, is that the members act as the trustees. This means they take on immense regulatory responsibility. If you have an SMSF, you are legally responsible for all the investment decisions and for making sure the fund strictly complies with superannuation laws.
So, as you might guess, SMSFs are absolutely not a free-for-all. They are bound by some very strict constraints. An SMSF can have a maximum of 6 members, and every single member must be a trustee or a director of a corporate trustee. They are heavily regulated by the ATO and the Superannuation Industry Supervision Act, or SIS Act. And here's a strict rule to keep in mind. No trustee is allowed to receive any remuneration for their duties. It's a structure completely built on responsibility.
All right, Section 3, introducing LRBA structures. With that foundation laid, let's look at how these self-managed funds can interact with external finance through a very specific tool.
Now this is a crucial point. An LRBA, which stands for Limited Recourse Borrowing Arrangement, is absolutely not a standard personal loan. Think about it. If you default on a normal personal loan, the bank can often come after your other personal assets. But an LRBA? It's a highly restricted legal structure living inside your superannuation. The clue is really in the name, limited recourse. If the fund defaults on the loan, the lender's rights are strictly limited to the single underlying asset tied to that borrowing. They literally cannot touch the other assets owned by the SMSF. It essentially ring-fences your broader retirement savings from the lender's risk.
Let's walk through the actual mechanics of an LRBA. You don't just go out and buy a property directly with a loan. First, you have to establish a separate holding trust. The single acquirable asset is then held in that trust, and the limited recourse finance is obtained. Legally speaking, the asset has to remain held within this trust until the borrowing is 100% paid out. Under official guidelines, an SMSF is generally prohibited from borrowing money altogether. They are only permitted to borrow under very specific exceptions, namely Section 67A of the SIS Act, which outlines the rules for LRBAs. These funds are kept tightly supervised to prevent any systemic risk to people's retirement savings.
And the rules drill down even further into the asset itself. Under an LRBA, funds can only be used to purchase what's called a single acquirable asset, like one specific property or a collection of identical shares. But here is where compliance gets incredibly strict. You can use borrowed funds to maintain or repair the asset so it keeps its functional efficiency, but you strictly cannot use borrowed money to improve it. If the work substantially increases the value or changes the fundamental character of the asset, well, that's an improvement, and using borrowed money for that is a major breach of the rules.
Section 4. Why LRBAs exist. Flexibility within boundaries.
So, you might be wondering, why do these complex, restrictive structures even exist within the Australian system? Well, they exist to provide specific investment flexibility. While larger retail or industry funds offer broad investment choices, an SMSF allows trustees to determine exactly what assets the fund will hold. An LRBA allows for the acquisition of an asset, like real estate, that the fund might not have quite enough cash to purchase outright. However, this flexibility always operates within strict boundaries, like the ATO's safe harbor guidelines, and every single decision has to pass the sole purpose test, meaning it is exclusively for providing retirement benefits to the members.
Finally, let's move to Section 5, Regulatory Policy Discussions and the Current Landscape. We're going to zoom back out to the macro level to look at current regulations, because the super system is routinely reviewed to ensure financial stability. To put the scale of all this into perspective, Treasury data notes that SMSFs actually account for less than 1% of total residential property borrowing in Australia, and less than 0.5% of new residential borrowing each year. So when you look at the big picture, it's a very small part of the overall housing market.
Currently, there are ongoing policy discussions aimed at maintaining the stability of the broader property market. The government has really focused on supporting fairer conditions for first-home buyers and promoting intergenerational fairness. As neutrally outlined by Treasurer Jim Chalmers, the stated goal of recent budget reforms is to help rebalance a system where, in the government's view, house prices have decoupled from incomes.
As part of these broader housing and tax reform discussions, there's an ongoing policy debate regarding the future of SMSF borrowing for residential properties. The main policy aim behind these talks is to prevent funds from competing directly with first-time home buyers at property auctions. It's really important to note, however, that any proposed changes typically discuss grandfathering existing arrangements, meaning current SMSF borrowings wouldn't be impacted. As it stands, superannuation continues to be periodically reviewed to ensure long-term stability without jumping to conclusions on any unconfirmed outcomes.
It certainly leaves us with an interesting question. As the government seeks to balance long-term housing stability with secure retirement savings, how will future superannuation policies continue to evolve and reshape the tightly regulated tools available to everyday investors? This content is general and educational. It is not financial advice. If you already have an SMSF or want to understand your compliance obligations, speak with the team at Wendy Super Accounting.